should you plan to pay your estimated tax payments in retirement? Well, here to talk with me about that is CJ Miller. He's a financial planner with Sensible Money. CJ, welcome.
Hey, Bob, how are you?
I am great, and I'll be even better after you sort of help us walk through this complicated question.
It is complex, and so we do have some examples to walk through. But before we do that, I want to take a few minutes and explain kind of why estimated tax payments matter. So for most of our clients, they haven't paid many estimated tax payments, or some are familiar. But the reality is most people at a certain point in their life will need to make estimated tax payments. And for some people, that's earlier in life. Maybe you start a business, and you have self-employment income. Maybe you have, oversized investment activity, like you sell your house and have capital gains. But for most of our clients, it is that they stop working. And so for years, they've paid taxes through their paycheck, and now they realize the nature of their income has changed from a tax standpoint. And so they need to make adjustments. The real reason that estimated tax payments are so important is it also creates a lot of anxiety within our clients is because of the phrase underpayment penalty. And so for people that don't pay in on time, the IRS does assess a penalty. The interest rate on that penalty is what's called the federal short-term rate plus 3%. And so right now that ranges anywhere from 7 to 8%, and that's assessed on a quarter or a monthly basis. And so when you think about earning maybe 4 or 5% on a high yield savings account, well, you're paying significantly more to the IRS. And so it's really, really important that you get your estimated tax payment situation in order. And that can be difficult to do in retirement because there are a lot of different moving pieces.
Yeah. There's another complication too, which I think if memory serves, there's the 90% and 100% rule. Is that right?
That's exactly right. Those are called safe harbors. And that's actually a great segue, Bob. So let me share my screen if I can.
Yep.
And then what we're going to be able to do is walk through some examples of this because these things are a lot easier to conceptualize with real numbers. Can you see my spreadsheet okay, Bob?
Yes, perfectly.
Great. So what we have here is the first example of a few that we've put out. And this is designed to illustrate what the IRS calls safe harbor. So in general, the way the tax system works is it's pay as you go, meaning that as you earn money, you're supposed to owe tax on it, pretty much the second you earn it. But they realize it's unrealistic for most people. And so what they've put together is a quarterly system because they want to simplify how much you actually owe. And so they also give you a few metrics. They're called safe harbors that you can track throughout the year so that you can avoid underpayment penalty. And so there's two general safe harbor rules. The first one is based on last year's tax, and the second is based on what you think this year's tax is going to be. And so I'll start with safe harbor 1 because this is the most common. This is effectively looking at last year, and it's calculated. There's one of two levels at which it's calculated. So if your adjusted gross income, this number here, is more than $150,000, then you have to pay in 110% of last year's tax. If it's under 150, then you only have to pay in 100%. So that's already the first nuance right there at the beginning. So in this case, adjusted gross income in this example is far more than 150,000, and so this person would need to pay in estimated tax payments 110% of their total tax from last year, for the first safe harbor. And so when you do the math, I used round numbers to keep it simple. So if you had $100,000 as your total tax, you need to pay in 110,000 throughout the year. Now, when is that due? The IRS has a, quote, quarterly payment system. And I use quarterly in, quotations because it's not actually quarterly. You owe the first one in April. It's April 15th. You owe the second one in June. It'd be June 15th, then September 15th, and then January 15th. Now, the justification for this, the IRS says that is more in line with most businesses' fiscal years and things of that nature of when income's actually received. What they won't tell you is that it's actually a byproduct of federal budgeting. And so the only time these rules change is when there's some kind of budget bill in Congress and they need to adjust the due dates to make the numbers work out for like deficit purposes. So I think the last time it was changed might have been the 1980s, and it was part of the budget process, for that reason. So anyway, I digress, but ultimately, that's when the payments are due. And then any remainder, right, if you don't pay in your full tax liability, you're going to owe that by April 15th, of the following year. And so if you follow Safe Harbor 1, basically you'd pay in $27,500 on the quarterly system here. to get to the full safe harbor amount. But that's not your only option. The other option is safe harbor threshold 2. And so the second safe harbor threshold is based on what you think this year's tax is going to be, and that is 90% of this year's tax. And so the same calculation would basically be 90% of this year's tax, which in this example is the same. So if you have the same amount of income, you can say, well, instead of paying in an extra $10,000 throughout the year that I don't need to pay in, I'm just going to pay in 90% of what I think this year will be and be, quote, safe harbored. And again, that has to happen evenly throughout the year. And so that alone can create a planning opportunity, because if your income's pretty stable, well, most CPAs and most off-the-shelf accounting software like TurboTax, when they give you estimated tax payment vouchers when you file your return in April, they're going to do it based on last year's tax, because you haven't told them what you think this year's tax is going to be. But if your income is typically pretty stable and you're doing quarterly payments, well, why pay in $20,000 more throughout the year and get a $10,000 refund, especially knowing that although the IRS will charge you interest if you're late, they're not going to pay you interest if you pay in. Mm. And so for a lot of people, they want to pay as little as possible until they have to. So in these cases, like when your income's stable, we tend to recommend safe harbor option number 2, although there is a little bit of risk there, because your tax picture can change throughout the year. But let's assume it's stable. Well, then in that case, you'd pay in $90,000, and then you'd pay in the additional 10 when you file your return, by April 15th, and you're paid up, and you've paid in as little as possible, to hit the safe harbor, and you're exempt from underpayment penalties. So that's the first example. Any questions about that, Bob?
No, that's pretty straightforward so far.
Good. Well, it gets complicated a little bit as your income changes, right? Because we have 100,000, for last year and 100,000 this year. That's why it's straightforward. As we start to look at other examples, we can layer in additional complexity. So this second example shows why that planning opportunity of really being intentional about your safe harbor strategy makes sense. If you just pay the vouchers that show up on your return, a lot of the time it can actually cost you quite a bit of money in lost opportunity of interest in the meantime. And also it can crunch cash flow depending on the nature of the income you're living on. And so this is an example that we see commonly where a client retires. And so now they do have a big disparity between last year's income and this year's. And when you look at the different safe harbor thresholds now, well, you see a much bigger difference. Instead of it being $20,000, if you use safe harbor 1, you pay in $110,000. But if you don't have any earned income, maybe your total tax is only $15,000. And so ignoring safe harbor version 2, you're going to pay in over, $90,000 more than you need to and get all that back in a refund, costing you interest and potentially just not having the cash flow, being kind of tight to pay your bills, depending on your financial situation along the way. And so this is why being intentional about the safe harbors matter. Because if you follow safe harbor 2, well, back to the rules, you'd pay 90% of this year's tax, which would be about a little over $3,000 per quarter, which is a big difference from using safe harbor 1.
Straightforward there too, CJ.
Good.
I think I can guess what tab 3 is.
Well, tab 3 is another complication. And so this is going to be, well, what happens if you do have a mix of income? And this is also very common, right? So this is common for people with self-employment income, right? Maybe you're paying yourself a salary from a business, and then you also have a K-1, you have distributions coming, from your business. Well, now you need to decide, well, how much do I need to pay for that income that's outside my paycheck? It's outside W-2 withholding. And so a quick primer on how any W-2 or 1099 withholding is treated is that it's considered paid on time and proportionally throughout the year, regardless of when it's withheld. And that's really important. So if you have a paycheck coming in and you withhold $40,000 throughout the year, that's effectively applying about $10,000 to each quarterly payment. It is not satisfying, all of quarter 1 and then part of quarter 2, and then you pay the rest. So it's not received first, it's received proportionally. And that's a big distinction. We've seen clients withhold a lot from an IRA, for instance, and then they skip quarterly payments for the first couple quarters, which can work out under a different method. But for the most part, ultimately, if you're just following the safe harbor rules, you can end up, led astray that way. Because regardless of when it's withheld, whether January 1st or December 31st, it's going to be treated proportionally in terms of application on the required payments. So what does that mean with numbers? Well, let's talk about it. So in this example, we're back to 100,000, whether it's this year's tax or last year's. And so knowing that this is proportional, it's as simple as taking the 40,000 that you're going to withhold. And basically, if you go back to the original example that this was based on, it was 110,000 and 90,000 as the two safe harbor totals. Well, now those are both reduced by 40,000. And then you end up dividing those by 4 to get your quarterly amounts. And so this can be useful, because a lot of our clients take money from IRAs. And so whereas you don't really have a ton of control over your W-2 withholding, it's dependent on when your employer pays you. On your 1099 withholding, you can have a lot of flexibility. So we've had cases where a client was on track to be underpaid, and we do an IRA withdrawal in December and withhold all of it for taxes. And that basically puts that client in a position to be now paid on time, because they missed the first couple quarters. And so there are cases where it can be very advantageous from a planning standpoint. But that's how you factor it in. So for those at home kind of calculating this on your own, start with the two safe harbors first without any of the W-2 withholding. Then subtract out the W-2 withholding proportionally and from each quarterly payment to kind of get what you're going to need to pay in for each deadline.
Right. CJ, this one does beg a question. You mentioned IRA distributions. In many cases, if someone's taking an RMD, that might come at the end of the year, December or so, late November, and they may have an option to have 20% withheld of the distribution, which would go to Uncle Sam and could be applied to to the safe harbors.
Mm-hmm. Yeah, that's correct. And one of the reasons we tend to delay IRA distributions unless the client needs the money for spending is because we have a clearer picture of what the total tax is going to be. And these examples are illustrative and they're straightforward because this number here is fixed in all the examples. There's no fluctuation. In reality, it never happens this way. And so what happens is you think you're going to have 100,000 of total tax, but unless you're very diligent about actually doing a formal tax projection, which we do for all of our clients throughout the year, you don't know exactly how much your total tax is going to shake out to be. Because you've got interest from bank accounts coming in and that amount's fluctuated quite a bit. You might have real estate activity where, maybe you sell your residence and it's not taxable, but maybe now you have a lump sum of cash that you're investing mid-year and that changes how much you're going to have in dividends. And so, nobody's tax is actually earned evenly each quarter throughout the year. It fluctuates. And so the benefit of, keeping IRA activity till the end is that, if you've been making modest quarterly payments, maybe you even, if you're really unsure of what your income's going to be, maybe you do use Safe Harbor 1. That's a good reason to use Safe Harbor 1 because that that's going to be a certain threshold that if you hit it, you'll be fine. Maybe you make the first 2 payments and then you realize, okay, I have a clearer picture of my, tax bill in quarter 3. And then you do the RMD for, the rest and you withhold less than 20% because you overpaid in the first 2 quarters. Yeah. Or the opposite, right? You could have, hey, I actually owe a lot more than Safe Harbor 1 was on track for. Let's go ahead and increase that withholding as a result and stay on track that way.
All right. You've got 2 more examples, I see.
I do. And these are where I think the analysis gets most valuable. So it actually just is a great segue because when we're talking about having scattered income throughout the year, it's not as common when you're accumulating money, but it is super common when you're decumulating. And there's really 2 major reasons that this happens for our clients that we see on a day-to-day basis. One is the realization of capital gains. And so when you have a large non-retirement portfolio that you've accumulated, maybe it's several $1 million worth potentially that you're now living on to retire. Well, when the markets are doing well, you want to rebalance. And you don't necessarily want to be thinking about the timing of your tax payments when you're making market-based decisions in your portfolio. And so as a result, maybe in the first quarter, you realize a ton of capital gains, and now you need to know how do you adjust your payment. Or maybe it's, the second example outside of capital gains is Roth conversions is another very common option. And so similar to IRA withholding, it's basically realizing IRA income. You're taking money out of your IRA and moving it to a Roth IRA. And although you could withhold taxes, it's typically better not to. it's typically better to pay the tax on that conversion using the estimated method instead of withholding from the IRA directly, which I can explain why, later. It's probably the subject of another video.
Right.
But ultimately, unlike the IRA withdrawal option, you don't have, it's typically not advantageous to withhold. And so, you've got to adjust your quarterly payments. And so what we see often is a situation like this. This is estimated tax example 4. And so here we have basically, 2024 tax is 100,000. That was last year. 2025 tax is the same, but this is the income that it's realized in each quarter. And so it's not as simple as saying, okay, they earned 25,000 each quarter. Instead, maybe they had 5,000 from investment income, maybe a few dividends, paid out in quarter 2 that were higher than expected. And then boom, quarter 3, you do a big Roth conversion, or you have a lot of capital gains, and now you owe a bulk of your tax. Well, you'll see here that I added a third option. And so the safe harbor rules are effectively, only the first 2 choices. But when you're looking at this and you look at the income as it's received here, it results in a very common question that we get from clients all the time, which is, CJ, how am I supposed to factor in my estimated tax payments if I don't even know if I'm going to do a Roth conversion or realize these capital gains until the fall?
Yeah.
And the IRS recognizes that. This is very common for business owners too, right? How are you supposed to make, say, $27,000 payments every quarter if you're a business owner and you haven't received that income yet, right? Maybe you just get a really big sale in quarter 3 and that's where all the cash flow comes from. You don't even have the cash to make the payments. And so the IRS recognizes they can't hold you to the safe harbors alone for people that have, stagnant or, scattered income. And so they give you this option to basically use what's called the annualized installment income method. Actually, it's annualized income installment method, which you could tell gets wordy, which is why I shortened it here. But it is the annualized income installment method. And so this is basically the pay-as-you-go. So this is a very rudimentary example, where basically, okay, well, you just match the payments as it's received. In reality, though, the calculation's very complex, and most off-the-shelf tax planning software like TurboTax and even some CPAs don't necessarily elect this on the first go-round. So if you have income where it's been fluctuating throughout the year and your payments have been made potentially late based on the safe harbors, well, you want to put yourself in a position where, you need to elect to use the annualized income installment method, or at least ask your accountant to. And most accountants aren't going to be able to do the calculation on the fly. It does take some complex software to get this right, because they factor in timing of your deductions and some of these other things. And so this is a very basic example. But here you'd be able to see, okay, this client pays in exactly $100,000 based on the area that it's received. Pretty straightforward. But again, that calculation can be difficult if you don't have the tools to say, well, hey, that quarter 3 payment should be $75,000 specifically, as opposed to, something different. So, in our financial plans, that's why we not only have big models that look, multi-year, but we also refine the projection with a formal software package that can dive a little deeper on the tax side.
Yeah. So one question about the annualized method, CJ, is I assume that if you have underpaid, so to speak, that you will avoid the underpayment penalty, assuming that you tell them that you've used this method.
That's exactly right. So like in this case, if you paid in 5,000 and then 7 and then 75 in quarter 3, and you don't tell them, the IRS, that you want to use the annualized method, they're going to look at the safe harbors and go, well, you were supposed to pay in at least 22,500 and you only paid in 5. So that differential, that $17,000 difference, that's earning that interest penalty all year, basically after April until you pay it. And so by telling them we want to do the annualized income method, it doesn't change how much your total tax is. It just changes how the penalty's calculated. Right. And so we've had clients where we review their tax return and that election wasn't made because they did a big Roth conversion and maybe they were self-filers and just didn't know how to do it in TurboTax, or maybe their CPA just missed it. And when we review the tax return, we're actually able to file an amendment for that client. We don't file it because we don't do taxes in-house, but we recommend that they have the amendment filed. And that client saves a ton of money on the penalties, sometimes even completely offsetting the underpayment penalty entirely.
Yeah. This alone, knowing about the annualized method, is worth the price of admission here, CJ.
Yeah, it is very little known. Most people don't recognize it even as an opportunity. It's why working with a qualified CPA is important in retirement, even if you're typically a self filer and you think you have a pretty easy situation.
Yeah.
So it's definitely something we recommend.
And I would assume that most CPAs who are working with, I don't know, CCH tax software or some professional tax software program would have this available to them. This would become an option, perhaps.
Yeah, absolutely. It definitely would. It's just more, making sure that the CPA knows that's an area that you want to pursue. And some are great and will do it automatically, and others may not. And so it's just about that communication. And so like the average filer at like an H&R Block might not pick that up.
Yeah.
Not picking on them, but when you have thousands and thousands of returns to file in the spring, sometimes you're following an operational workflow and this might get missed.
Yeah.
It's the nature of any kind of business like that.
Yeah.
And so we have one more example, Bob, and it is basically just for fun, putting it all together. Okay. And so here we have the annualized income installment method, right? So let's say it's the same situation as before where you've got this big tax incurred in quarter three, but let's say now we actually have withholding. And so, maybe you're withholding from Social Security or you also do an IRA distribution. Well, how does that impact the quarterly payments with the annualized installment method? And so remember, this is applied proportionally to each quarter. And so it's going to be $5,000 for quarter one. And so, this is basically the original quarterly target up here. Well, the first quarter is satisfied completely. So you don't need to make a quarter one payment. The second quarter, right, you only need to make a $2,000 payment. Right, you would take 5,000, a quarter of this, and subtract it from 7 to do 2, and then so on and so forth. So then you just subtract 5,000 from each payment to stay on track. And so this, back to that strategy of maybe you do an IRA distribution late in the year and withhold. Well, if you didn't pay 5,000 for quarter one and now it's December, you could do that distribution and fulfill that obligation later on.
This has made things very, very complicated very simple here, I think, CJ, quite frankly.
Good. Yeah, and there's one more caveat just to be aware of is also check your state income taxes. So certain states, like I'll give you an example, California, they don't really have a third quarter payment. So they owe in quarter 1 and 2 and then quarter 4. They also have a rule where Safe Harbor 1 using last year's tax goes away if your income's over $1 million. And so totally different set of rules at the state level. We had a client sell a property in California and his income went up just for that 1 year. And so using last year's tax was a lot lower of a safe harbor figure, but because it drove his income up over that $1 million threshold, we had to be careful about making the estimated payments to California based on this year's tax alone, just knowing that. So the state rules, state by state can vary. So just be cautious of that, especially if you're in a high tax state like California or New York.
Right. So just to go off script for a bit, if someone was to Google how to plan for estimated tax payments in retirement, as I just did, they might find something interesting around having taxes withheld from both your Social Security benefit check and perhaps even your pension check as well, filing different forms, W-4V in one case and W-4P in another case. Have you encountered that in your practice?
Yeah, we do have some clients withhold Social Security, but I'll be honest with you, Bob. We might give different advice to a do-it-yourselfer versus someone working with sensible money. And so for a do-it-yourselfer, somebody is just managing their own retirement, withholding from each source is pretty simple, right? Because ultimately, you have a little bit of tax coming from each income source and you'll stay kind of on track as those income sources can fluctuate. But from a tax projection standpoint, it makes things more complicated, right? And from a tax filing, you've got more 1099s. If you want to do a formal tax projection, you've got to go pull a lot of different documents. And so knowing that most of our clients on Social Security also are going to have IRA activity, we actually recommend that pensions, Social Security, really anything outside of the IRA activity, assuming that's going to be enough to pay most of the taxes from there, we recommend that you withhold nothing from those other sources. Because for our clients, that allows us to basically manage the tax withholding all within our umbrella. right? And so we'll have clients where maybe they only need to take a $50,000 IRA distribution, and they have income from other sources that they haven't paid tax on yet, and so we're actually going to withhold like 70% of the distribution. And I'll have the client call and go, "Well, hey, I saw this withdrawal. Why are you like my tax rate's not 70%? Why are you withholding so much?" And then I explain, well, you have your Social Security you're not taking withholding out of. You've got portfolio income potentially, so all those things result in that one-time transfer being withheld at a higher rate, but that satisfies your obligation for the whole year.
Right.
And so like you might not even need to make estimates. Like we have all this safe harbor, items here, but for some people, if your IRA distributions are big enough, I'll give you an example. If we made this 100,000, oops, you'll see basically that you'll satisfy the whole tax liability from that one transfer. And so that would put you in a position where you don't have to pay any estimated payments. The lowest safe harbor amount is negative, which is effectively zero. And so that's a strategy too for people that just want to ignore all of this complication and say, hey, I just wasted 15 minutes watching this video because I'm just going to withhold all my taxes from my IRA. We have many clients that do that too.
So what about payment? Do you prefer that someone sends a check by mail or use the electronic funds transfer?
I prefer going to IRS direct pay because ultimately it's a pretty, I'm not a cybersecurity expert, but I've used it before. It is a very secure process. And I've never seen a client use direct pay and have some kind of fraudulent activity happen as a result. I know a lot of people are hesitant to basically give their banking information online, especially to a government institution sometimes. But if you mail a check, you're actually more likely for the check to get lost in the mail. Maybe the IRS, decides that they misplaced it or something, right? And says we never received it. And then you're arguing with them about whether or not you actually mailed the check in the first place on time. So it's best to avoid that and just use IRS direct pay. There are also services that, so I'll get clients that ask this, well, can I pay my estimated tax payments with a credit card to get the points? And the answer there is it's typically not worth it because there are sites that can do it, but you're going to pay a fee. Yeah. So you're usually going to pay like a 3% processing fee, which is going to offset the value of whatever points you're going to get. But if you have like a big sign up bonus or something, that could be a way to achieve that too.
Yeah. Anything we've missed or bears reemphasizing?
No, I think that covers everything. So I hope this video was very helpful. Like I said, this is one of the most common questions that we see, and there's a lot of confusion about the safe harbor rules. So, just to summarize, safe harbor one's based on last year's tax. That's typically going to be 110% is the target. Safe harbor 2 is 90% of this year's tax, if you can figure out what that's going to be. And then for unique situations where you've got kind of lumpy income throughout the year, that annualized income installment method is the way to go to pay, as little in as possible until you absolutely have to.